Hi, I'm Justin Struble, and I want to talk about how much leverage you should use in investment real estate. Now, if you are in this space at all, you probably have an opinion, but you've probably heard everybody else's opinion as well. Some people say, oh, you should never use leverage. You should buy it all with cash because it's investment, yada, yada, yada. Dave Ramsey philosophy. The other side is, oh, you can get in zero money down. You don't use any of your own money and you benefit by all the upside and the bank takes all the risk. It can only set you back a decade from making huge mistakes, but that's the other extreme. The reality is everybody is probably somewhere in the middle. And where that is not arbitrary. It's not random. It's not personal preference to say, oh, I'm a 80-20 kind of guy or I'm a 50-50 kind of guy. It's not that. It's based off of your household finances. So I want to give you some rules of thumb, which aren't precise to you specifically, but they get you much closer than generic assumptions that you hear in the industry. So here are the rules of thumb, and then I'm going to give you 3 examples on different households and what that might look like. We're going to do a household that is a $100,000 a year income household, a $300,000 a year income household, and then a high net worth household that may have what's on paper showing up as $1 million of income as a household, but I'll get into the details there. But here are the rules of thumb. When you are buying an investment property, you can put as much cash dollars down as you want, but the amount you leverage, the amount you borrow from the bank, should be limited by 2 factors. 1 is your household income, and 2 is what I call your available cash flow. Now, for most people, this is your savings. If you are saving 10% of your income, great, that's your number. If you might be saving in vehicles that are unreducible, let's call it that. For example, you might have a 401k and the portion that you get a match on. If you put 6%, the company puts 3%, I consider that not available to redirect towards what may become a bad real estate investment. And that's where we're getting this from. We're saying if things get really bad, where are the dollars coming so that you don't go underwater and lose this investment? You want to make sure you weather those storms. So in that sense, if you have a 401k contribution, you might be putting $20,000 a year into it, but $5,000 of that might be unreducible. It's a bad idea to reduce it below that match percent because that's free money. You might also have something that you are on a fixed payment, your mortgage, car, something you say, yeah, these are dollars that I could redirect. I could go refinance a house or something, but I'm not counting that as that's a significant change. This isn't reducing your lifestyle saying, oh, we can just stop eating out if we have to pay for this. Because if you're in that stressful situation, you're going to need these pleasures in life, and you're not likely to cut out all of your luxuries just to survive this, what could be a bad real estate economy. The other thing is you might have a cash value life insurance policy you're paying into. That's a rigid payment. You don't really want to reduce that. There are some policies you can reduce it and it doesn't completely screw it up. But if some of your savings each year goes into that type of a vehicle, that's not what I call available cash flow to redirect. It's not available. But for simple terms, let's call it your savings rate because that is applicable to most people. But realize there's all those caveats I just mentioned. So when we look at it, when we talk about income, household income, where's the level for that? A good place to be is 2 to 3 times that household income. And I'll get into the details with these 3 examples. A good place to be on a multiple of your cash flow is 10 to 15 times your cash flow. So let's do an example. Let's just go in size order. So a household making $100,000 a year, let's say it's a younger couple, and they're able to save 15%. Let's use the Dave Ramsey rule. They're saving 15%. They're doing great. All of that is redirectable. It's available cash flow if something goes bad with their property. Now, off of their income, their household income, they're making $100,000. They can borrow $200,000 to $300,000 towards an investment property. And when I say that, this is not your personal residence. That's a different conversation. But they already have their own home. They're saying, hey, we want to go buy this investment property. Okay, just off of that criteria, somewhere between 2 and 300,000 is an acceptable borrowed amount. Now they've got 50 grand in the bank that they're going to put towards it as well. Okay, 200 plus 50 is 250, or 300 plus 50 is 350 for the purchase price. That's one criteria. The other criteria is their cash flow, their savings rate, available cash flow. And when we look at this, we said, okay, they're saving 15% towards all their future goals. And we're assuming all of this is redirectable if they needed to survive a bad real estate market, a bad scenario with this real estate. That means they're saving 15,000 a year. Well, 15,000 a year times 10 is 150. 15,000 a year times 15 is 225. Off of that criteria, they should be between 150 and 225. So you put these two together, and the guideline or the target for them would be somewhere around 200 to 225,000 is a good, healthy loan towards an investment property. Now that means if they're looking at $400,000 properties, they need to come up with a cash for the other 175 to 200. And with everything, there are reasons you should break rules, but these are the rules, they're guidelines, they are generalized. Use your own judgment, but that is a very good rule where if things go really bad, this property turns into a dud, the economy turns into a dud, you're going to be able to survive because you're going to be able to redirect your cash flow, your income is high enough, you're going to survive this real estate lull when it comes. All right, second example. Let's say you are a household, middle-aged couple with kids, family, whatever it is. You have 300,000 of income. You're doing well. And let's say you're saving 20% of your income. 20% means you're saving 60,000 of your 300,000. That's great. And we're assuming this is all redirectable towards the real estate to survive a bad real estate market if you need to. Not cutting into your lifestyle to survive it, but truly redirecting your future savings. Same multiples, 2 to 3 times your income. So on a $300,000 income, that's 600 to 900,000 can be borrowed towards investment real estate. 10 to 15 times your available cash flow. If they're saving 20%, which is 60,000, times 10 means 600,000, times 15 is 900,000. That actually lines up perfectly with that scenario that I just said with the income. So their income and their savings are very in line. 600 to 900,000 is an acceptable borrowed amount towards investment real estate for this household. Before I jump to the third scenario, let's look at another one. Let's say you're making 300,000 as a household, but you're not saving 60,000, you're saving 15,000. Whatever it is, it's going somewhere else, you're not saving it. Now, these dollars, this 15,000, you go back to our first scenario with the younger couple making 100,000. The 15,000 savings rate, $15,000 saving, is actually limiting the borrowed amount. So if you're a $300,000 household and you're only saving 15,000, then you don't want to borrow 600 to 900,000 on an investment property, because if it goes bad, you're going to owe a large bill and you're not going to be able to pay it. That's why that cash flow part is important, because now you need 15,000 times 10 to 15. You're in that 150 to 225 range again, which means if you buy an investment property, one, you can pay cash, but if you're going to borrow, keep that borrowed amount around 200,000. That's a number you as a household can consume and survive with if things go poorly without changing your lifestyle. If you say, oh, I can change my lifestyle, well, change your lifestyle now and save it. And then next year, let's go get an investment property. So now let's go to the third household. Let's say this is an older couple. They've accumulated a high net worth. Now, we're not talking about income that their investments in a 401k or an IRA do, but maybe they have some other real estate. Maybe they have some non-qualified stock accounts. And maybe they still have a very good income. So let's give them a $500,000 earned income and another $500,000 that's coming from, let's say, their net worth. Let's say they're worth $10 million. And so they've got these two complements, and if it's showing up on their tax return, then it truly is showing up as income. And therefore, when they're showing $1 million of income, the question is, how much are they saving? And if they're earning $1 million, and let's say they're doing great and they're saving 300 grand, let's look what those numbers look like. If their income is $1 million, multiply it by 2 to 3, they could borrow for an investment real estate deal 2 to 3 million. If you look at their cash flow, they're saving 300 grand a year, they're putting it back into their investments. Say, okay, great, 300 grand times 10 to 15 is 3 million to 4.5 million. So right there, just above their income lines, which means they're probably looking at $3 million is kind of that cutoff where you say, yep, your income is pushing it, but your savings rate is excellent. You still probably want to stay right around that 300,000. Excuse me, $3 million borrowed towards an investment property. Now there are extremes where maybe you're worth 100 million and you're saving a significant portion. Okay, these are rules. They can be broken. That's up to you. Everything's individualized. But these rules will get you a lot better, a lot closer to the right answer than the generic answer you get from a real estate investor or some real estate entity that's trying to sell you investment property. Saying, oh, it'll pay for itself, blah, 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 blah. The point is, if things go south in this property or in the overall real estate market or in your local market or something in your life, you don't want to get completely devastated because of one to a handful of real estate projects. Keeping these limits will keep your finances in check where yes, you can use leverage. Yes, that improves your return, your ROI, return on investment, but it doesn't over leverage you where you just get completely caught in a bad cycle and you're completely upside down. It's also an added concept here is it's nice if you don't use it all in one property. Now, if you're starting out, it's small, you're looking at it saying, hey, we don't have that much that is in this realm, this price range. Okay, maybe you're using it all in one investment property. But certainly as you grow over time and you say, oh, I'm looking at another property, it's very nice to have some time diversification. Saying, oh yeah, I bought this one 3 years ago. Now I'm looking at buying another one in the next year or two. And hopefully your income has gone up, your savings has gone up, and it opens up this allowable borrowing rate. And if you buy one property and it does positive cash flow, that's now income to you as a household, which is also hopefully a higher savings. And it will naturally allow you to go into another property in a few years saying, yep, our cash flow has gone up, our income's gone up. We're now, quote unquote, fixer approved for another loan for X number of dollars. I hope this was helpful. If you're looking at investment real estate, I'm happy to have a conversation with you, but really make sure you don't get overextended. But there is some value in using leverage, especially in real estate where the interest rates, even today, are pretty acceptable. They're pretty decent. I'm Justin Struble with BSG Advisors. I'm not a broker, I'm a fixer. I'd love to have a conversation with you. Give me a call, shoot me an email, and please subscribe to this channel. Get some more content over time. I'm here to add value to you. Thank you.